Hi, everyone, and welcome to the Macro and Global Liquidity Analysis Gold, Silver and Bitcoin monthly update for October 2025. Proudly brought to you by AinslieWealth.com, where you can find all of the latest research that we're presenting here today. I'd like to start by welcoming our panel back. They've been here every month with us. We've got Joe and Paul. Look, we're going to have an interesting discussion today because we're having an interesting discussion yesterday in our investment committee meeting. How are you going today?
Yeah, very good, mate.
Yeah, been here every month except for last month when Drew was here.
Well, almost every month. I was trying to weave that in. Look, we were talking last month about this Uptober idea, and it's kind of played out and kind of not, I think, is how I'd start with this today. What do you think?
Well, like seasonally, August, September have been weak. So if you've got a weak August and September, then and you just need the price to stop going down to have October, I suppose. Like that's how I would look at it. That makes sense, doesn't it?
Well, it's certainly played out in the precious metals, Paul. I mean, we had a monster of a month and then a pullback now. It depends where you look, I suppose, when it comes to October this time around.
Yeah, and a growing narrative around the debasement trade, right? But and as you said, ordinarily September's tight because of US tax season and other factors, but then throw in a government shutdown and the money's still trapped. So that's anyway. We'll speak to that later, but there's some pretty clear reasons why October hasn't played out just yet.
And when you said the government shutdown and there's so many different aspects going on that any one of them historically would have been almost front and center that you're paying attention to. But when they all happen at once, the market just seems to shrug it off and just carry on its merry way regardless. Look, before we dig in a little bit deeper, I want to reiterate to people, I think we were giving ourselves a little bit of a pat on the back yesterday, Joe, about just how when you and I were talking, we were saying it's just so good that we can filter out a lot of the noise because there is a lot of noise around at the moment. And we do that really through this process of the investment committee. I thought I might sort of introduce this today by just talking about that, if you want to sort of start with that. And then, Paul, I'll get you to sort of follow that up with what we're specifically doing around the fund. But Joe, it really has been useful to stick to the things that we're talking about today, hasn't it?
Yeah, and to your point, there's a lot of narratives. Like when you're talking about Bitcoin, you're talking about gold and silver. When you're talking about gold versus silver, the narratives out there and what people believe to be true can be true for a period of time, but not necessarily an ongoing truth, if that makes sense. So we're very data driven in terms of following liquidity and the macro cycle and where we think asset prices should be based on a relatively fair value against liquidity.
And it's keeping that consistency every month and just going sort of back to that same data, because then you can identify, like we will today, some of the things as they're changing. Paul, the Ainslie Group, we've been around for a long time. There's sort of stuff on there that's been up on the slide to show people we've been around for over 50 years looking at all this sort of stuff. When we talk about the fund, do you want to give us a little bit of an overview there of the fund itself, but more importantly, this process that we've been going through as an investment committee? Yeah.
Look, the fund ultimately is about having Bitcoin that enjoys these this liquidity environment more than any other asset, and then but it has a lot more volatility, and then we've got the gold and silver that gives you the protection when things go wrong, but also gold and silver are highly correlated to liquidity, as we'll speak to later. So really, we then have this process where our economic advisory committee advises the investment committee on where we think we are. That's a weekly meeting, and we've got the likes of Jamie Coots, who's head of crypto at Real Vision. We've got Paul Engeman, who's a lifer in the fund space, and of course Josh Lang, our fund manager. Then taking the information that we discussed today, this is actually part of the process, and us being very transparent too with our audience and our investors, so they know they're on the journey of how we're deciding where we invest and when we invest. So this is just part of a transparency piece that shows in live time our sticking to this framework, and as you say, filtering out the noise. So it's a great fund at the right time, because this debasement trade that everyone's talking about, yes, we've had a correction, but nothing's changed in that sense.
No, and we'll definitely dig into the data on that. Look, before we do start more of that deep analysis, just a reminder to everyone that everything said and shown in this presentation is intended for general informational purposes, does not take into account your particular circumstances, objectives, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. Okay, so we'll follow the same format that we've sort of always followed along here, starting off with where we currently are. So we'll have that big picture view first. Joe, I'll start with you here. We've seen this is our sort of snapshot, and we chose very actively to ignore this recent sort of bear market signal in Bitcoin because we think we're not necessarily at the end of we're certainly not at the end of the macro cycle yet, and we also don't think we're at the end of the liquidity cycle. Is it becoming a little bit more challenging for you? How, are you fairly confident that we still have more to go in this rally? How are you viewing it?
I think we're definitely closer to the end than we are to the beginning, right? So specifically when you're looking at asset prices in gold and Bitcoin, if you think about how far we've come and the duration of this current liquidity cycle, which has been going on for well over 2.5 years now, there's probably the expectation that things are going to continue on as they have been over the last 2.5 years are probably not realistic. So as we go through our liquidity model, and yes, we are still early cycle, but we'll go through the reasons why we probably are about to go through mid, and then also why we think liquidity is probably not going to continue expanding at the current rate or the recent history's rate. Because at the end of the day, it's about the rate of change of liquidity as markets are forward-looking versus the nominal amount of liquidity.
And that becomes vitally important when we look at this chart, Paul, because this is showing us what Joe was just talking about, that the rate of change is somewhat stalling. We're seeing those blue dots just across there, but the economy itself is still in that early phase. I think this is going to catch a lot of people out.
Yeah, because everyone's talking doom and gloom and recession and that sort of thing. The data just does not support that. So and again, we've got to stress, we look at the world, we don't look at the US. Okay, so we look at the S&P's PMIs. They're at 52.5, and yes, manufacturing is lagging, but it's still close to 50. And if you do need to drill into the US, there's a host of data, and Julian Bittel from MIT, in his latest piece, just shows chart after chart after chart showing growth is coming, right? And if there's any sort of bellwether amongst all the Fed releases, it's the Kansas one, and it's just come out clearly showing growth in manufacturing as well, which is an important piece to this because that's the bit that's struggling the most with tariffs and whatnot. So when you look at forward-looking data and even snapshots of where we are now, I expect us to be back in that mid-cycle pretty shortly, and just draw a line through all of that too. It's still an up to the right trajectory. We've spoken time and time again why this has been a bumpy bottom, but it's early cycle because of a whole lot of headwinds that we've had, and those headwinds are easing, and the data is showing we're going into mid-cycle.
And I think we'll definitely come back to this in a minute because I really want to pry apart the difference there between the economy being able to do well and liquidity potentially pulling back and what impact that's going to have on assets. But if we just start with the big picture view here of Bitcoin, Joe, that's what I was referring to before when I said we've just really chosen to ignore this latest sort of signal suggesting price going down. It is recovered a bit at the moment. I mean, even since this chart, it's a little bit higher, and I think we're heading back towards the blues and greens on this particular indicator. But it's really this point that you said before, probably closer to the end. We have to be much more cautious as we approach this end because, as we'll talk about, the difference between the liquidity continuing to increase in rate of change and the economy growing, you can have one without the other, and it doesn't necessarily mean Bitcoin continues to go up.
Yeah, we'll absolutely talk about that. Specifically, if you're talking US and economic growth and liquidity, I know you've got a number of thoughts on it in terms of targeted spending, which necessarily doesn't find its way into financial markets, more so into the real economy. And if it's not finding its way into financial markets via what we would say is the fastest route via QE or Fed liquidity, it has to be held up by fiscal spending, and that eventually does find its way into markets, but it's a far slower process.
And that's that, like what we were talking about, really that speed is important, because if it takes 6 months, 12 months longer for it to get into those markets, that's how you get bear markets, right? that's what bear markets are. They're sort of pullback because there's no fuel there to keep the bull market going. I mean, that's
it's rate of change, like I mentioned before. If the rate of change is slowing, yes, something can still be increasing, but if it's slowing down, then markets are forward looking and they can see that it's slowing down, and profit taking will begin before, or liquidity will tighten before you actually get the nominal downturn in numbers.
Yeah, and that's a very good point. It's not so much what's happening today, it's what is clearly about to happen next that the market will respond to. The more clear it is, the better, in terms of markets front running it. Look, let's dig into the liquidity cycle part of this in a bit more depth. Paul, we've shown this chart many times, that the idea that we go from boom to bust, and it's always driven ultimately by liquidity. In the latest update that we've got here in the index itself, you can see that rate of change slowing down. It makes it very difficult to predict here, because if that is the top, for example, I mean, it's possible that is the top in the rate of change and that it sort of slows down, but that's not necessarily meaning that it's just going to plummet to the lows either, does it?
No, it doesn't. And as Joe just alluded to, then we've got a changing dynamic at the moment. So a lot of those last couple of cycles has all been about Fed QE. So the central banks, inflating financial assets through buying the bonds. We're now seeing those go. That's actually in QT at the moment, but we've got an enormous amount of issuance at the short end out of treasuries, and that's this whole fiscal dominance that we keep talking about. As you just said, that's slower to come through, so you would expect that to tick down. I think probably the thing that everyone's watching is, people talk about TACO, the FACO, Fed always chickens out. Is something going to happen where we see the Fed actually come around and introduce some form of QE by whatever name? But we don't know how long that arrow could tick down and what that could do to assets. So we're highly anxious at the moment in terms of just watching where that goes. As the previous chart said, the indicators are we're heading into a mid-cycle. These things normally happen late cycle. So that part of our framework is telling us hold strong. And the fact that there's an enormous amount of money sitting in the TGA that could flow out as well. But, you often make the point. It's QE does not have the same speed. So this rate of change that we're, that index is, that index is not just quantum. It's also the rate of change in the direction. So, it's a concerning dip, but one that can't reverse just like all the little dips before it.
Yes, and that's a good point as well. If we can see that, so we have to look a little bit further into the data to see whether there is a potential for that to pick up. I think something that concerns me a little bit, Joe, I'll get your perspective on this, is this weekly global liquidity has certainly been up and to the right. Like there's no denying that chart. It's almost a straight line, and has been since all this year, right? Like, so it's just been up and to the right in terms of increase. The issue is that rate of change again. So we know over the long term, the nominal figures, which is what this is showing, are always going to increase. Like, that's sort of how the system works. There has to be more liquidity over time, but the rate of change not keeping up, and also the components that make that up. I'll probably ask you about that in a second, Paul, like some of the components here that are leading to it. But Joe, how do you reconcile the fact that we see week after week this sort of nudging higher of total global liquidity, but we're not seeing the rate of change really pick up? Like, in some ways, I would imagine if I was a central banker, I'd actually see that as really positive. I'd say, well, we're keeping the system going and we're just not getting the excesses. Is that how they would view it? Like, how do you think about it?
I think from the we've had, in terms of QE, not being supportive. Like, so a lot of this nominal value here is because of bond volatility coming down and because of collateral prices rising, as in yields falling, and also large issuance at the short end of the curve. So a lot of bill issuance, which makes for good collateral. So that's why we continue to see this number go up and to the right. The problem with that is that, yes, over the coming, probably the next couple of months, which I'm a little bit more bullish on, there's going to be a lot of this short-term issuance from the Treasury. So from their guidance, they're looking to do around 60 to 70% issuance in bills, which is a huge amount of bills to be used as a collateral base in the financial system within the US. So over that period of time, I'm quite bullish. The problem is that once you get to the end of the year and they need to start signaling to the market, as in the Treasury need to start signaling to the market how they're going to start refinancing, to keep up a rate of issuance, of bill issuance at 60 or 70%, like to increase the rate of change, you need to go even further than 60 or 70%, which is probably not going to happen, right? So it's back to that rate, like that it constantly needs to be increasing. It needs to get faster and faster and harder the entire time. And I just don't really see how that's going to continue on. So this can continue to grow, but at what rate and for how long?
And that's kind of my point. Like, if you're the central bank, they're probably happy with it continuing to go. They might not necessarily want that excessive rate increase, so that you really start to see the rate of change increasing. But the problem we have with that is that when you're looking at asset prices, we know asset prices to go up need that rate of change to continue increasing. So this could be heralding potentially a bit of stagnation in asset prices is how I'm looking at it, because I don't know that you necessarily, if you're the central bank, you're not necessarily running to fix a problem when, from their perspective, it's probably quite fine. I mean, I'd like to dig into this a little bit more, Paul, what Joe had just said around a lot of what's actually driving that is not central bank action itself. I mean, looking at this chart, you can actually see it almost sort of falling down if you look really closely, squint in at the black bit there. But it's really those other factors, and I worry about those as well, that they could change quite quickly.
Yeah, and thank God, because central banks are around the world, with the sole exception of China. Like the Fed tightened 27% in the last 3 months, annualized. ECB's in the teens, UK's in the teens, Bank of Japan, like it's that if it wasn't for a 39% 3-month annualized rate from China, central banks, this would be all over. So, but that chart does remind us that they're a relatively minor component of it. The signaling is huge in terms of interest rates, but a lot of it is just, again, global liquidity is effectively the balance sheet of the global financial system. So the collateral of that balance sheet is paramount. That's bonds. Bonds are at, just about recent historic lows in terms of volatility. So there's less haircuts off that collateral. The US dollar, whilst creeping up, is still relatively low. That's the other piece in that pie. So yes, central banks are tightening, but the bigger piece here is the bonds and the US dollar that are lackluster, but keeping us certainly up and to the right. And that chart people need to remember that previous chart has to keep going up and to the right, because this is a Ponzi scheme. At the end of the day, they have to keep printing money to roll over the previous debt and issue new debt for the continual deficit. So don't ever confuse that up and to the right as liquidity index, because, as you say, it's the rate of change that is instructive on what happens with Bitcoin and gold and silver.
Just so I can give my views, sorry, just flick back to that, Chris, that previous chart. So while we've seen that black line that black line basically go flat, and we talk a lot about China and what they're doing with liquidity, we need to remember that China has basically a manufacturing economy. So a lot of the liquidity will find its way into the real economy. Now, also, when you look at liquidity from the Fed in the US, generally speaking, a lot of that liquidity finds its way into financial markets. So whilst that's sort of where the concern comes from a little bit, because we know that the Treasury are trying to target the real economy. And Bessent said that, and Powell and Moran, who's currently now in the FOMC as well, are saying that they don't necessarily want to support financial assets because of that wealth inequality. So that's why they're not coming quickly to the table with QE. In saying that, at the moment, and we'll touch on it with bank reserves, we do expect over the next 6 to 8 weeks a flooding of bank reserves back into the banking system, which will be liquidity positive as the government reopens. But we'll talk about that and pull up the chart.
Yeah, and Paul, I want to just dig a little bit deeper into something you said a moment ago around the other, like, this is the whole world. If you look at the sort of colouring on there with the global liquidity, it's, I mean, obviously more green than red. It is in everywhere else has sort of been adding liquidity around the edges. That probably is less relevant than this, which is the point that you're making. The major central banks really are the ones we need to watch. It doesn't really matter what that heat map looks like at the moment, because when you look at this chart, and this is the numbers on that are the 3-month rate of change that you were talking about before, you can very clearly see the point that you're making. Everyone is not helping the situation except China.
No. Yeah. The yellow on that top left is G4. That's down around -20, right?
Yep.
And even the other two, including more broadly, it's still negative. So with the exception of China almost touching 40% there, central banks are, and this is, I keep saying, it's kind of not a surprise. The sheer scale with which they gobbled up assets in COVID, I mean, they've got a lot on their balance sheet they've got to get rid of. So they're all doing quantitative tightening. Bank of England's, but like, they've been doing quantitative tightening whilst they've been dropping rates. So they're just trying to, I guess, get their powder dry for what we've talked about before. When something happens, something breaks, as it has to when we're got reserves this low and bonds where they are. When something breaks, they just want as much powder dry as they can. So I think they'll keep doing this until something breaks, and then we'll see a pretty quick turnaround.
Well, part of my concern with this is when you look at that China one on the top right, that they have been all over the place. Like if you were to give an award for most consistent, you would actually give it to Bank of England, right? Because they have been very consistently for two years now pulling that liquidity out, and they haven't really budged. They just went, no, this is what we're doing. But I mean, they suffered under immense inflation. They probably had the public will behind them to do that because people really were suffering as a result of that. But China has been a basket case. Like, it's been all over the place. It seems to be cutting.
Yeah, but it's, Bank of England can do that because they're the unfittest person in a marathon. They're going to keep coming last, right? So whereas China have had this tug of war where everyone knows that they're struggling. Like, their economy is probably the worst it's been in some time in terms of the recent GDP prints and that sort of thing. But they also have the yuan that they're trying to support so they don't get a capital outflow as well. So they've been dancing this very erratic dance where they're trying to ease to get things going, but not damage the yuan and see it fly. So and the US dollars come to the rescue. So that lower US dollars supported it, and they've gone pretty hard. Pretty being an understatement. They've gone very hard of late, to the point where it's probably keeping the rest of this up, where we've got that nominal up and to the right.
And I think that's my concern, is just the risk aspect of that.
Yeah, you don't know what happens next. But what we do know is their economy is still not great, so they still have to do something. Yep.
Yeah, no, that is very very true. It's just when I look at that and go, oh, when the whole world seems to be relying on the back of that. I mean, I know, Joe, you would say there's potential, like that US one will pick up a little bit. There's specific reasons why that's so low at the moment, but still it seems very volatile to me. Look, we'll pivot a little bit here because there's something I really wanted to talk to you about this month, Joe, which on the deep dive on the macro, it's this chart here. We've talked about this a lot. People who are reading the reports I put out each week will know that there's always like this little asterisk on the end. The thing that could blow this up at any moment is the bank reserves, because they are well below what is the anticipated rate that adequate, whatever adequate means, but adequate, it's below that. It's maintained it below that. And really there are stresses in the system that could cause what in quotes would be a black swan event. All of a sudden you start to see banks collapsing or issues occurring. we've always been, why I particularly want to focus on this month is we've always been of the opinion that in the event that something starts to wobble and we start to see some bank failures, we'll very quickly see the Fed change course. The discussion we were having in the investment committee yesterday is our opinion is starting to change a little bit on that, because we're now getting very clear wording. You mentioned people before who are saying this isn't about, we're not trying to support financial assets, we're trying to support Main Street. That means maybe we don't get that knee-jerk reaction from the Fed that we're all used to. Just talk us through this.
In the short term, you may not get that knee-jerk reaction if you start to see asset prices fall. Like, it also obviously depends on the bond market and how volatile that becomes, particularly if it's volatile to the downside in terms of asset prices. I think it just goes back to policy not wanting to ramp up QE, which is effectively what we're seeing here, right? We're seeing QT, we're seeing bank reserves fall, and they don't want to be seen as supporting financial markets or effectively the wealthy versus the Main Street. So it's just become a massive political issue. So if we're going to touch on this quickly, obviously the yellow line is the current level of where bank reserves are. So if you think of bank reserves as the money that sits in the background so banks can transact with each other, which is different from you and I transacting with each other if we're sending deposits, right? Banks can create deposits. They can't create bank reserves. They can only move them around. The only entity that can create bank reserves are actually the Federal Reserve. So when there is a scarcity of bank reserves, which potentially causes issues in the financial plumbing, the only entity that can save the banks or increase liquidity is the Fed. So currently, cross-border capital's perceived amount of adequate reserves is around 3.3 trillion. The Fed currently thinks it's around 2.8 trillion. So you'd probably have to say that the Fed are incorrect at this point, because we are seeing a few of those funding issues in the market. A number of banks are tapping what they call the standing repo facility, which is effectively a collateral swap for bank reserves, so they can fund themselves overnight. So that's starting to happen more and more frequently, which is telling us there is stress in the system.
And that's a really. Sorry, you're probably going to say the same opinion, Paul.
Yeah. I'd like Joey to just walk the audience through that SOFR Fed fund rate.
Yes, because
that's one of the flashing signals, right?
It's really this is stuff that is complicated to understand. Most people will be completely unaware of what's going on there. But when Joe's saying here that there are some stresses in the market, like these are real things that get missed by most people because they simply don't understand them. So I completely agree, Paul. I'd love to know a little bit more about this.
Yeah, so the stress in the system is seen by the difference between what the target rate for the Fed is and what the actual market rate is. So the SOFR rate, the overnight refinancing rate, right? So the Fed have what's called a target rate, which is set by the discount window, which is the upper part of the rate. And if someone wants to borrow from the Fed, that's what they can borrow at. And then you've got the bottom part of their rate or their floor, which is interest on reserves. So that's what banks get paid on their reserves. So the idea of that is that in between anything between there is what the Fed would ideally want rates at. So when rates start to go above what the discount rate is, or the borrowing rate for banks from the Fed, that means that they've effectively lost control of interest rates, because banks are now going to have to go to the Fed or demand a high interest rate to lend out their reserves, if that makes sense. It's a bit of a longish concept. It's probably better with a chart, but underlying issue is that banks are having to pay more to borrow reserves to get them through the night than what the Fed would ideally like.
And how you explain
you can almost, I think, another way to picture it, like a lot of viewers that are into metals or Bitcoin will understand backwardation, right? Which makes no sense in theory, right? So in this sense, we've actually got secured borrowing dearer than unsecured, right? Because there's such a lack of cash.
Yep.
So that's another way to look at it in terms of those two instruments. So when something doesn't make sense, then you know there's stress in the system.
And the other way you explained it to me yesterday was if you thought of what they were doing, like in practical terms. Every night they're having to operate this facility, so it's not really sustainable. Like, it's something that you could do every day, but it's there's a lot of actual process involved in that. It's not just a simple running business as per usual. There'll be people involved that have to do something unusual to what they would normally do. Like, that also, to the point that Paul just made, like that also indicates there's stress in the system because it's not normal.
Yeah, and I think we need to remember that that standing repo facility where banks are borrowing reserves for overnight is only something that's come about since 2019 when we actually had the repo crisis. So at the moment, even though it's being utilised more and more because there is stress in the system, I don't know how long that can continue on without something. Like, it could go for a while. Like, how long's a piece of string? So,
But
you know, it might.
it's not a normal
No, it's not. But
function of the market. It's something they introduced to solve another problem, and
yeah, and that's right. So, how long is a piece of string in terms of how long it could go on for a while, where the standing repo facility is more than adequate to top up reserves, or it might finish tomorrow. Who knows?
And that will be a big part of that is a big part of the theme that we're struggling with at the moment. Is we can see the problem on the horizon, but when that is going to occur is difficult to pick, particularly against this background. Paul, I'll switch the pace slightly to talk about the growth aspect of this that you were highlighting before. That the growth is looking quite good. It's looking like the economy is actually picking up. That's kind of what you would expect when you've got the government, particularly we're talking US here, but you've got the government more than happy to spend. In fact, that's their active policy right now.
Yeah, absolutely. And throw in a new sector with the AI build out is enormous, right? So we've got that coming as well. It's a bit of a coiled spring because the TGA is filling up. When that starts to empty, that goes out into the economy, and you're ordinarily, and hence probably why some of that forward looking is so constructive, is that we are seeing things turn around. Amongst a bunch of different metrics that indicate growth should start. Now, I feel like we've been saying this for a long time because you can see the way it's bounced along there. But that's also part of the tariffs on, tariffs off that we've just been going through for that whole period as well, because it is affecting manufacturing. Manufacturing is tepid. Services are pretty strong. They're up, well into the mid 50s. But it's globally. So from a US point of view, you can see that services are still sitting at the 50 line. Globally, it's a bit better. And it's just part and parcel of this uncertain world we're in, where people are probably keeping a bit of powder dry themselves.
The other side of this that we need to be paying a little bit of attention to, and to the point that you were making there about we've been on and off on this for a while, the growth aspect, we probably are seeing that now because the money is actually starting to flow. That's the difference. I think too, a lot of it we were anticipating the money flowing. It just wasn't flowing yet, but now that it is, I think this is the real one. I think we are going to see the growth, but the concern is going to be around inflation. And we saw numbers out of the US the other day, 3%. And everyone was sort of happy with that because it was under expectation. Now, we've talked about this for a long time. 2% was always the target. We didn't get anywhere near that in the official numbers. I mean, our leading indicator got below there, but the official numbers never got anywhere near 3%. Now you're near 2%. Now you're seeing 3%. Well, I mean, we said this for a long time as well, Joe, that was maybe going to be the new normal. I think part of my concern, and I want to dig into this with the bonds shortly, is that if 3% is the new normal, it's going to put a lot of pressure on the bond market. And I don't know that 3% is where it's going to stay if we see all this spending going on in the economy.
Well, if you think back to what QE was, for example, QE was effectively money moving into financial assets, which benefited the rich. But that's still a very small portion of the population. Now, if you're targeting the economy, it's basically you're putting more money in more people's pockets. So you've got a wider array of people with more money, which is going to cause more spending, because rich people can only spend so much stuff. Whereas if you give money to a wider group of poorer people, they're going to spend it more into the economy, which is why we think we're not going back to COVID level inflation, but we're saying that we probably have bottomed here, like in terms of how low inflation or CPI is actually going to get. So that's the difference between QE monetary expansion and this fiscal monetary expansion that we're going through right now. Now, to your point and what you raised yesterday and what we spoke about, if you've got a 3% CPI or 3 handle on inflation, potentially moving towards 4, and you've got short-term rates, the 2-year, for example, it's currently sitting at 3.5%. I don't understand how, while we have somewhat of a free market, how short-term rates would stay below the rate of inflation. Like it doesn't make any sense unless a buyer of last resort, being the Fed, come in and suppress rates by purchasing everything under everything that goes over 3.5% or 3% or something like a heavy QE or yield curve suppression.
And this was an interesting part of the discussion because they can certainly do that, right? Like no one's denying that the Fed can come in and buy any buy up bonds and do whatever they want, right? They can do that. I think the issue with that would be massive in terms of sentiment, massive in terms of confidence in the US government and its ability to operate a free market and service its debt. Like that, to me, that's almost throwing in the towel and conceding defeat. So I don't think that's going to happen. Well,
I think also what we need to remember is if they would come in and buy these bonds to suppress yields, like it's good for risk assets because you're signaling to the market, don't buy bonds, go out in the risk curve, right? But also it's the Fed helping the government directly fund its fiscal spending, like which all QE effectively is. But we've never been on such a fiscal spending binge that we're currently about to go through, and then you've got the Fed on top helping out with that as well. So,
and that is, and I know we've got to be cautious. When we talk about the potential for things like hyperinflation, right? Like we don't want to go down that path of being sensationalist on it, but ultimately hyperinflation comes about, or at least very high levels of inflation. Let's not necessarily call it hyperinflation because the US is a very unique case, but very high levels of inflation come about because of a loss of confidence where people go, and expectations setting in. They go, oh, well, okay, now inflation is just going to keep feeding on itself, and their expectations are that prices will be higher, so I'll raise my prices today so that I can try and get some of that gain because I'm going to lose it tomorrow when the prices go up. Like it's a very dangerous game that you can slip into very quickly.
I would arguably say we're still in that from COVID. Like if you look at, like the US is actually worse than Australia in terms of those inflationary pressures.
Yes.
If you just looked at anything that you have to buy day to day, or your health insurance, or your car insurance, or your house insurance, like all my insurances and like the kids' school fees went up 12%, right? Now inflation's 3% apparently.
Went up like 15% for a lot of people. It's
your rate went up 15%.
Like,
so arguably we're still in it. But because the rate of change, and it's back to that rate of change thing, because it's slowed from COVID levels, it doesn't seem so bad. Like it's all perspective at the end of the day, which is what rate of change is, right?
Yes, and it does. I suppose this is an angle we've got that's slightly different to what the market seems to be saying at the moment, because I really do see we could certainly get another rate cut there, but looking purely at this chart, I don't see how we can get multiple rate cuts ahead, because it would push that yield lower than the inflation rate. And I just don't see why is anyone buying when you've got a lot of debt you need people to buy. They're not buying it when your headline rates don't make any sense, where you're losing money guaranteed straight up because the inflation rate is higher than the yield.
Yeah, well, you need someone to step in who's not financially incentivized to buy them. Like it'd be like a purely political economic actor that would have to buy them, and that entity is the Fed. So
yeah, because other countries certainly are doing. I mean, we saw that. Paul, you were talking about that the gold play where central banks had actually overtaken the US government debt on balance sheets. So they weren't having power of it.
Well, one more thing on that previous chart we should talk about too is, so a lot of what this administration is trying to do. So yes, there's Treasury QE to try and get to get money into the real economy as well. But there's a lot of talk about deregulation of banks, and also what this beautifully much steeper yield curve means is that it brings in the private lenders as well. So the opening up of liquidity into the system with that curve at the moment means we've got yet another. So if you deregulate banks, if they change the SLR, you get more private credit into the system. That's all new money that could keep this going. Whilst these same surveys are showing that this forward-looking growth piece is getting a bit of support at the moment.
And to follow up on that, I want to talk about the dollar. You mentioned this before, Paul. The idea that the dollar had a little bit of strength of late. I mean, I'm not. We had differing views on this presented yesterday in the investment committee that potentially it was going higher here. We've had for a while a view that it could continue lower as well. Like the dollar is just really difficult to pick. What do you just want to maybe, rather than try and predict what it's going to do, maybe just indicate what the likely outcomes are if we do see continued strength? Because part of the reason I'm not so convinced that it's going higher necessarily is because during this period where it has had a little bit of strength, it really hasn't gotten we haven't seen much of it. Like looking at that chart, it barely got anywhere. Whereas during the down periods, it's certainly lost a lot of ground. What's the likely outcome in both scenarios?
Yeah, look, and FX markets are completely impossible to pick. If we do see this go higher, then that absolutely is going to be more headwinds. So, a lack of October could mean a lack of November as well. Because if that comes up, it's as I said before, the collateral, the bond market and the US dollar are two of the bigger contributors or influences on global liquidity. So if that's going up, then I think we see more headwinds for a while. But if and arguably part of how it's kept down here is that same uncertainty I spoke about before. So, whether it's weaponization through sanctions on Russia or whatever it might be, if there's continued fear around the US dollar, and people continue to put their reserves, or sovereigns continue to put their reserves elsewhere, we may well see it stay down here and even dip lower. But a dip lower would be very, very constructive for the assets that we're looking at.
Yeah, it's so frustrating for us as a committee because it's such an important part of what determines where global liquidity goes. Yet it's actually the hardest one to predict in many ways.
And an extreme view that some may have seen put forward is that for all of the scratching of head of what the hell Trump's going to do next, it's all a calculated move to keep things uncertain, keep the Fed more likely to drop, keep the US dollar down. It could be a deliberate, so what looks like erratic, nonsensical behaviour could be a very calculated move to ease, because we can't forget the $9 trillion of debt that they have to roll over. They want rates down. They want the cost of that to come down, and they need the liquidity just to even finance it. So it's not out of the realms of possibility that that's exactly what's playing out.
And that is consistent with the points we were making before about that nominal chart that was going up and to the right. In some ways that could be exactly what they are happy with, because at least it's increasing even though the rate of change is slowing. If we turn specifically to look at Bitcoin here, we've talked about this multiple times. We clearly know global liquidity is connected to world wealth. We've talked about that. We know that Bitcoin and gold, and we'll talk about gold shortly, but Bitcoin is the most correlated to that. So that's really important. Part of what we were talking about, Joe, for the last several months is this little turn down that we've had in the rate of change on this chart, at least, suggesting sort of that slowing lined up very, very nicely with that short to medium term top that we saw in Bitcoin more recently. It looks like that's potentially slowing in terms of the rate down of change, and that we might get a stabilization or even that picking back up, which was our base case. Is that still on the cards for you here?
Yeah, so I've been saying that for a number of weeks now, that I believe towards the back end of the year, as the rate of change starts to pick up, we should have a good back end of year. And, based on where I foresee Fed liquidity over the coming 6 to 8 weeks into the end of the year, as the TGA is drawn down, the government reopening happens. That will increase liquidity and also drive this number up. Now, obviously, we've got other factors like China, which seem to be quite hell-bent on stimulating. So, while their rate of change may slow, I think it will remain positive. But that's why my view, as in for the next until the end of the year and possibly even into early next year, is still bullish. But obviously, if bank reserves come up with some sort of problem and we have an issue in the repo market and bonds sell off, then that can cause anything to fall in price. So, that's my view on this chart at this point.
And that would line up with, I'll ask you about this one, Joe, because Paul bullies me on this chart. But if you look at this one here, we've seen in terms of the nominal, it reflects quite well the expectation, at least while that continues to point up, that we would see Bitcoin recover. And that is so far what's happening, but it would even suggest here more to come. And that would be consistent with your view into the end of the year.
Yeah, so obviously there's a divergence there between Bitcoin and liquidity. We'd expect Bitcoin to catch up at some point. Doesn't mean it has to happen today or tomorrow or next week. But also, based on what I was just saying in terms of the large amount of bank reserves that have come out of the Fed in the next month or so, the large amount of bill issuance that's going to occur and throughout the rest of this quarter, as long as we don't get huge volatility in the MOVE index, which is bond volatility, or the US dollar, I think that orange arrow is going to continue pointing up for the rest of the year. And I would assume at some point Bitcoin catches up to that very quickly.
And the sort of last one in this Bitcoin section, Paul, we've got the cycle, like the sort of 60-day cycles. It's been a very choppy one, and we won't ultimately know whether this was left translated or right translated just yet. But we saw that really early explosive move higher. When you consider just the magnitude of what happened this month, when you look at the biggest liquidation event in the history of crypto, all of that happening, when you zoom out and look at it like this, you wouldn't even know it was there.
No, it's all relative. And if this isn't left translated, then strap yourselves in for the rally over the next couple of weeks. It's
it could literally, like looking at that last chart, looking at what Joe was saying about the rate of change on the shorter term picking up, it could absolutely be right translated, and we could see that high quite quickly.
Yeah, and not an exactly organic 60-day cycle either. As you say, literally the biggest liquidation event in history.
Yeah.
So absolutely, it could well do. It could, we're late in the year. That's when it gets most excited. So we could well see that get above that 125, 126, whatever it is. It's or it chops, and then we actually see the rip in the next cycle.
And people forget, I think, sometimes the nature of the beast, that just because we've had many months now of relatively subdued price movement, that these things can happen in Bitcoin. That's what it does. And you sort of look back at this similar period last year, that November period last year, it really, really took off, which would look quite extraordinary if it did the same thing again. So it's a good point to always remember that it doesn't always stay constrained in really tight ranges. Look, gold and silver we need to talk about this a little bit, because it's been a massive month. From the bullion business side of things, it's been just flat out. I've been standing on my feet for way too many hours. I don't like doing that. I've had to do manual labor. I've complained about it incessantly, but it just goes to show how busy it has been. And when you look at this chart, which doesn't even really reflect, because this is sort of looking at the average numbers for the previous month, it'll be off that chart again. It's just been an absolutely monster run. Just talk us through what is actually driving that. What's going on?
Well, I think this chart tells you to some extent, but it's so as you say. So last night it came off reasonably heavily again. So we're just a smidge under 4,000 as we sit here at recording. But this whole debasement trade, so something we've spoken about at length for months, if not years, has caught the mainstream. So hence the lineups to get into our stores and the price action that was seeing near vertical. So for context, what did it get to? 4,700, and we're back down to 4. So 1,000 on top of, so if you scale that, we're up above the screen. So it's quite extraordinary.
And all that's happened in the time that I haven't even been able to update it because we haven't got a new month yet. Yeah, it's crazy.
Yeah. And when you look at a chart that actually is correlated, then that tick down in global liquidity index, it was a precursor to what we've now seen with the sizable retracement. Now, that same narrative of debasement trade has not gone away. It's exactly what we've just been talking about, right? This is fiscal dominance at large that mainstream is starting to cotton onto. So this will be a healthy and necessary pullback, but the narrative still is strong in terms of the story for gold and silver. Our job in the fund is to pick which is the strongest, and that's because Bitcoin's also still down relatively. So it's really picking the best horse in that race. And silver.
Well, because I wanted to dig in and ask you specifically about silver here. The debasement trade primarily would be about gold, you would think. I mean, it's certainly the central banks have been buying it for a long time. Retail has jumped on recently, which is why you sort of get that real volatility in the move. But is silver the same trade, or is there something different at play?
So silver's the same trade, but it's a smaller market, and we saw extreme stress. Like I talked about that backwardation. So it was under severe backwardation. There was the leasing rates were through the roof. Shorts looking for physical cover were buying up SLV ETF shares to the point where SLV had to stop. So there was a absolute squeeze in the supply of silver in that point because it is a smaller market. It's clunkier to move, but they're literally flying silver by the tons over to New York. Silver normally goes by boat just for general interest because of its weight. So it was the same play, but with those that were looking at gold taking off and a GSR still quite high, thinking this could be the time when the GSR reverts. So silver became the go-to, but it slipped back to just under 47 now. So it's had a bigger up, it's had a bigger down, but it's still holding relatively strong. It just got overexcited for a bit.
And the GSR, I mean, we talked about this, I think last week in our committee meeting, this idea that we have to remember, even though there was a little bit of a dip in the GSR, which means silver was outperforming, historically, when you zoom out this 100-year view, that it can still go a very long way.
Yeah, it's as I was just checking on my phone, it's 85 today, right? So that is pretty much where that chart is right now. So a minor dip came down from early 90s down to mid 80s. So it's still high, and those that are very much into cycles and that sort of thing are saying, what do you do with this pullback? We only get the big pullbacks once that GSR gets low, and it hasn't. So there's a number of factors pointing to this being a shortish term pullback for gold and silver, and GSR is certainly one of them, and still leans heavily into silver being the one with the bigger performance potential from here.
And I mean, I've had a long-term view that $100 silver is like almost a price that is it has to hit at some point. And when we're talking all of this, we were still sitting around that 50, so there was still a lot of room for that to move. Even on this chart in particular, you can see that the potential for that being there. Look, we always like to keep an update for people on our simple trading plan. We've been following that along from the start, which was really just to follow the chart we showed at the start, which is to buy when we get that buy signal, sell when we get the sell signal. We're not there yet on the sell signal. We've had discussions about it this week saying, it may not be that far off, but probably still months away. But really the performance of that for people who bought back on January 10th, 2023, it's, 566, nearly 567% over that period of time, annualized rate of 202%. I mean, it really is an unmatched gain. And it's interesting because I was having a conversation with someone the other day saying, it's been a really difficult bull market. It's been really choppy, and you get knocked out, and it's a challenge. And you go, well, yes, but if you really kept it simple, it was been probably one of the most remarkable. It's been consistent with the other really big bull markets. There's a lot of money to be made there when you've made more than 5 times your money over really not that long a period of time. So it's all about how you look at it, I suppose. But that's our update on that anyway. It's doing very well, and that sell signal up the distance. Look, that's the end of our formal sort of analysis bit here. I'll do what I do every month and let everyone sort of wrap up with their sort of thoughts ahead and where we are and where we're heading over the next month. I think I'll just sort of, well, from my view, just reiterate what I just said there around that chart. Really, we have to sometimes pause and have a look at how well we've done over that cycle so far. It gets harder from here. We've been saying that for the last little bit of time. It's harder to get exactly, as we approach that top of this particular cycle. But, we probably need to sit back and just go, well, we've done pretty well so far. So, maybe we don't have to stress too much about being exactly right at the top. But that's my view. Joe, what are you thinking?
Yeah, very, very similar thoughts along the lines of what you just said. Like I said, for the next couple of months, I can see where the liquidity is going to come from. So I'm quite positive on Bitcoin itself. Going into early next year, I'm not so sure. We'll have to assess that towards the end of this year or early next year. But like if just looking at that performance that you've spoken about, we came all the way from $17,000 to $114,000. So I think if we were to get another leg up and price was to outstrip the fair value of liquidity, it would be a profit-taking moment for certainly myself, and I know you would be, but also for anyone who's interested in looking for something like a bit of an indicator to take some off the top and move some into lifestyle chips.
Yeah, good point. Paul, your views on that, and also if you've got any, I mean, because you sort of have your finger on the pulse of the metals all the time as well, any sort of final words on that as well?
No, I think it's, the key things I'm watching carefully are that US dollar and the catalyst for the FACO trade. Like it's, and to be clear for the editors, FACO, if we're just going to see when the Fed's going to step in or when central banks will step in. So whatever event that is going to be, could serve up a beautiful dip buying opportunity because we know what comes next. So that's what I'm most focused on is any signs of stress in the system, US dollar spiking, I think will be quite instructive.
And the metals on that basis as well, you would expect to take off in that environment?
Yeah, absolutely. As I say, everyone's buying on the the debasement trade. Debasement hasn't stopped. it's changed gear. So yes, Fed QE, Treasury QE is slower, but as Joey said, there's a heap of money sitting there that has been accumulating in that TGA that must be released at some stage. It'd be how quickly that gets through and shows up as a change in pace of liquidity. That'll be the one to watch. But tops are always anxious moments. So we're watching with great curiosity.
We are indeed, and that's why we're back here every month as well, so you can keep up with our latest thoughts on that as it unfolds. But thank you, everyone, for watching our update this month. Thanks to Joe. Thanks to Paul for your contributions and analysis today. Really appreciate that, guys.
No worries. And apologies if watching me has made anyone seasick. I'm trying to keep my head
down. Like you can be watching the markets from anywhere. That is the dream of everyone, I think, to be analysing from the boat. But look, I always value any feedback.
It's a tough job, that bullying job.
It is a tough job. Meanwhile, I'm jamming my fingers in things, but don't worry about me. I'll survive. Well, I never complain.
Stop hitting your nose. Yep.
Yeah, well, that might have been part of the reason. But anyway, always value feedback and discussion. So you can follow me on X at Tipper Analytics to stay up to date and reach out if you have any questions or comments. Also, we love those comments and feedback in on YouTube or wherever you're watching this to let us know what you're thinking. So always appreciate that. We'll be back in November with the next monthly update to reassess and identify what has changed. Until we chat again, good luck in the markets.